What is going on, everyone? Welcome back to the channel. It is April 30th, 2026, and today the market is absolutely on fire. We are talking double-digit percentage moves in multiple megacap names, a surprise implosion in one of the most beloved tech stocks, and a semiconductor giant that just went absolutely parabolic. I have got the top 5 stocks dominating the tape right now: Qualcomm, Eli Lilly, Caterpillar, Alphabet, and Meta, and I am breaking each one down with real technicals, volume data, key levels, and my 3-month price targets. Let's get straight into it. Alright, let's start with the biggest mover of the day, Qualcomm, ticker QUALCOMM, up a massive 14% to $177.85. Volume today is coming in at over 48 million shares, compared to an average daily volume of about 35.9 million. That gives us a volume ratio of 1.36 times normal, so institutional money is absolutely pouring into this name today. This is almost certainly an earnings-driven catalyst, and the market is rewarding Qualcomm in a big way. Now let's talk about the technicals, because the chart is telling a fascinating story. The 20-day moving average sits at $137.69, and the 50-day is at $135.77. Qualcomm is trading nearly $40 above both of those levels right now, which tells you this move has completely reset the near-term trend. The stock is now right at its 200-day moving average at $177.88, which is a critical inflection point. Bulls want to see Qualcomm close above and hold the 200-day level. If it does, that opens the door to the 52-week high of $205.95. Here is the one yellow flag I want you to be aware of: the RSI is sitting at 92.6. 92.6. That is one of the most extreme overbought readings you will ever see on a major large-cap stock. Anything above 70 is considered overbought. We are at 92. That does not mean you sell immediately, but it does mean chasing this name right here at the open is very risky. The 6-month high is $181.29, so there is a near-term ceiling just about $3.44 away from current prices. My 3-month price target on Qualcomm is $195, with a rating of buy, but with the caveat that you want to wait for either a pullback to the $160 to $165 support zone, or for the RSI to cool down below 75 before initiating a position. Key support is at $160, and resistance is at that 6-month high of $181.29. Qualcomm has a PE ratio of 19.12, which is actually very reasonable for a semiconductor leader with this kind of earnings power. Long term, this is a compelling name in the AI and smartphone chip ecosystem. High conviction, but patient entry is the move here. Next up is Eli Lilly, ticker Eli Lilly, up 10.64% to $941.82 today. Market cap is $841 billion, making this one of the largest healthcare companies on the planet. Volume today is 5.67 million shares versus an average of 3.86 million, a volume ratio of 1.47 times normal. Again, this is institutional buying with conviction. Now the technical picture here is more nuanced than Qualcomm, and frankly, it is more constructive for new entries. The RSI is sitting right at 50.5, that is almost perfectly neutral. That is a massive contrast to QCOM's 92. What that tells you is that despite a 10% surge today, Lilly is not in overbought territory, which suggests this move may have more room to run. Let's look at the moving averages. The 20-day SMA is at $915.58, and the stock at $941.82 is comfortably above it. The 50-day SMA is at $949.01, so we are still slightly below the 50-day. That is the next level of resistance to watch. If Eli Lilly can close above $949, that would be a significant technical confirmation. The 200-day moving average sits at $942.22, which is almost exactly where the stock is trading right now. That is your line in the sand. Now the big picture context: LLY's 52-week high is $1,133.95, and it fell all the way down to $623.78 at the low. The stock has recovered significantly, but it is still about 17% below its all-time highs. The 6-month high is $1,108.09. So the question is this the beginning of a recovery back toward 4 digits, or a dead cat bounce? I think it is a legitimate recovery, driven by the ongoing dominance of GLP-1 weight loss drugs and strong pipeline execution. The PE ratio at 40.98 is rich but justified for a pharmaceutical company with this growth trajectory. My 3-month price target is $1,020, rating is buy, and I would call this a medium confidence call because we still need to see the stock reclaim the 50-day moving average at $949. Support sits at $900, a round number that also corresponds to recent consolidation, and resistance is the 50-day at $949 followed by $1,000 psychological level. Number 3 is Caterpillar, ticker CAT, up 10.26% to $893.20. And here is what makes this one extraordinary. Look at that 52-week range. The 52-week low is $311.02 and the 52-week high is $896.98. CAT is basically trading at an all-time high right now. In fact, the 6-month high is $893.20, that is today's price. This stock is breaking out to new highs in real time. Volume is 3.56 million shares versus an average of 2.45 million, volume ratio of 1.46 times normal. Solid confirmation of the move. Now let's dig into the technicals. The 20-day SMA is at $792.17 and the 50-day is at $746.68. Caterpillar is trading a full $100 above its 20-day and nearly $150 above its 50-day moving average. That is an extraordinary distance from its trend-following indicators. The RSI is at 75.7, that is in overbought territory. Not quite as extreme as QUALCOMM, but still elevated. Historically, when Caterpillar gets this stretched above its moving averages with an RSI above 70, we tend to see a consolidation or modest pullback before the next leg higher. The PE ratio at 47.54 is actually quite elevated for an industrial company. CAT traditionally trades at a more modest multiple, so that valuation premium is worth monitoring. What could be driving this? Caterpillar is a direct beneficiary of infrastructure spending, reshoring of manufacturing to the United States, and global construction demand. Any positive news on trade policy, infrastructure bills, or better-than-expected earnings would send this name flying, and clearly something has happened today. My 3-month price target on CAT is $920, rating is hold for new investors. The run has been spectacular, but chasing a stock that is 20% above its 50-day SMA with a 75 RSI and a 47 PE is not the highest probability entry. Current holders should absolutely let this ride with a trailing stop around $840. Support is at $840, which was recent resistance, and resistance is the 52-week high at $896.98, which is just a stone's throw away. Number 4 is Alphabet, parent company of Google, ticker Google, up 9.04% to $381.58. Market cap is a staggering $4.6 trillion. This is one of the largest companies in the history of capitalism. Volume today is 54.1 million shares versus an average of 34.4 million, volume ratio of 1.57 times normal. This is one of the highest volume surges we are seeing across the entire tape today. The technical setup on Google is very similar to QUALCOMM, meaning a monster gap higher that has pushed the stock to extended levels. The 20-day SMA is at $332.38, the 50-day is at $313.74, and the stock is now trading at $381.58. That is roughly 15% above the 20-day and 21% above the 50-day moving average. The RSI is at 86.9, deep in overbought territory, but not quite as extreme as QUALCOMM. Here is the context that makes Google particularly exciting. The 52-week high is $380.83. The stock is trading at $381.58. It is within $4.25 of an all-time 52-week high. And the 6-month high is also $381.83, which essentially means the stock is at the top of its recent trading range. A clean break above $385.83 would be a massive technical breakout with very little overhead resistance. What is behind this move? Alphabet continues to monetize AI across Search, YouTube, and Google Cloud. If earnings beat expectations on both top and bottom line, which this price action strongly implies, the market is re-rating Google higher. At a P of 29.08, Google is actually quite reasonably valued relative to its growth rate, especially compared to some of the other names we have covered today. My 3-month price target is $420, with a rating of buy and high confidence. The combination of reasonable valuation, near record volume, strong earnings momentum, and proximity to all-time highs makes this one of the most compelling setups in large cap tech right now. Support is at $355, resistance is the 52-week high at $385.83. A break above that level targets $400 to $420. Alright, last but definitely not least, and arguably the most important conversation of the day, is Meta Platforms, ticker Meta, down 7.93% to $616.05. While everything else on our list is ripping higher, Meta is getting absolutely hammered. Volume is 40.9 million shares versus an average of 19.2 million, that is a volume ratio of 2.13, the highest ratio of any stock on our list today. More than twice the normal volume is hitting this name to the downside, and that is a serious warning sign. So what is going on? The technicals tell a painful story. Meta peaked at $796.25 over the past 52 weeks, and it has now dropped to $616, that is a nearly 23% decline from the top. The 20-day SMA is at $645.54, and the stock is now trading $29 below it. The 50-day SMA is at $630.93, also above the current price. When a stock is below both its 20-day and 50-day moving averages with this kind of volume, the near-term trend has definitively shifted to the downside. The RSI is at 46.2, which is approaching but not yet at oversold levels. That actually concerns me. It means there could be more selling to come before we reach the 30 level that traditionally signals a bounce. The 6-month low is $525.72, and the 52-week low is $520.26. Those are the levels bears are going to start targeting if this selling pressure continues. What could be driving the sell-off? Heavy spending on AI infrastructure, potential ad revenue headwinds, regulatory concerns, or simply a major miss on forward guidance? The market is clearly disappointed by something in the earnings report or outlook. At a PE of 22.4, Meta is not outrageously expensive, but the market is repricing the growth outlook lower today. My 3-month price target on Meta is $590, with a rating of hold, not a buy yet. The reason I am not calling it a sell is that Meta has demonstrated remarkable resilience historically, and at some point this becomes a compelling value. But right now, with price below both the 20 and 50-day moving averages, above average downside volume, and an RSI that has not yet reached oversold, the risk-reward does not favor new buyers. Wait for the RSI to hit 30 or for price to find support around $580 to $590 before considering an entry. Support is at $590, resistance is the 50-day SMA at $630.93. High conviction hold, do not buy the dip yet. Alright, let's bring it all together. Today's winners are Qualcomm and Google, both rated buy with high confidence, both driven by strong earnings and institutional volume. Eli Lilly is a buy with medium confidence, watch for it to reclaim the 50-day at $949. CAT and Meta are both hold, CAT because it is already extended after an incredible run, and Meta because the selling pressure has not yet exhausted itself. As always, do your own research. This is education, not financial advice. If you found value in today's breakdown, hit that like button, drop a comment telling me which stock you are watching, and subscribe so you never miss a daily analysis. I will see you tomorrow. Stay sharp, stay disciplined, and trade with a plan.